So welcome back to my Cooking the Books series, a series of videos designed to explain one or two ways that companies can try and catch out investors using accounting sleights of hand. Now in this video, I want to take on the topic of brands and goodwill. I've done a bit of work on this in another video, what is goodwill, and that's worth taking a look at. So here I want to deal with brand names specifically. Now that means I'm dealing mainly with the balance sheet. I'm saying that there is a way that the directors can kind of mislead you as to the total value of their company, but I'm also dealing a little bit with the impact on the profit and loss account. And at the end, I'll give you the takeaway message if you're nervous about a set of accounts that might be taking advantage of what I'm about to describe. So what is the problem? Here's the problem. If you pick up two sets of accounts for, say, a football club, all right? So you've got two football clubs, and there are quoted, listed football clubs around, and you open up the balance sheet, that's the statement of assets and liabilities for one, and you open up the same statement for the other and put them side by side to do some comparison, you might think, crikey, this one is much bigger than this one. The balance sheet's worth a lot more. What's going on? Or if you were to do the same exercise with software companies, for example, get two companies in the same sector, open the accounts, okay, or the set of accounts at the balance sheet page, looking for the value of the company using the accountant's balance sheet, and open the other company at the same page and try and compare the two. And people do this, they go, I want to be able to compare two companies in the same sector. You'd hit the same problem. One balance sheet might be a lot bigger than the other. Why? And the answer is something called goodwill and brand names. In football clubs, okay, this might sound a bit bizarre, but in football clubs and in software companies and in all other companies, in fact, that are subject to reporting accounting standards, you've got this problem. You can only recognise the value of something you've bought in the balance sheet. So imagine you're a football club that spends a lot of money on football players. Right? You go out and buy your talent, and you can probably think of one or two clubs who do exactly that. Every time you buy a player, that player is an intangible asset, believe it or not. Okay, people talk about our biggest asset being our people. Well, in football clubs, it can be literally true. So the player is stuck on the balance sheet. All right, so let's say you pay, I'll say, pretty generous £20 million for a football player. Okay, you go out and buy that player. What would happen in the accounts? Well, you're allowed to say, well, actually, that creates an asset in the balance sheet, an intangible asset of 20 million. And then depending on which sort of accounting rules you're following, it'll depend around the world as to which set of accounting rules you're following, what you would normally do is then write that off over the useful life of the player. Okay, and you'd be hoping the player doesn't get injured in the meantime and is then impaired, as accountants wonderfully call it. Well, they certainly would be if they break a leg or something. Then you have to work out how much less they're worth. Okay, now, without getting into the nitty-gritty of how football clubs do that, here's my point. If you buy a player, they appear in the assets of the balance sheet, and then you'll get an amortization, usually, cost. So the club might decide to write that off over a certain period, all right? Or you might get an impairment write-down. This is all horrible techie language, but it just translates an impairment write-down as, the player gets injured or it's worth less than you initially paid. You've got to work out some way of writing that 20 million down, and there are committees of managers who get together in secret to help the accountants do all this stuff, by the way, asking the question, what are players worth? Now, so far so what? So you've got this asset in the balance sheet, a player, because they're going to be generating revenues over several seasons, so you stick them up in the balance sheet, you don't just expense the 20 million straight away, and you have some kind of impairment write-down or charge through profits. Now my point is this company will have a bigger balance sheet than a company that home grows its playing talent. Because there are other clubs, of course, who don't spend a lot of money on players, they can't afford to. They home grow their talent. And some of that talent, think about David Beckham, for example, okay, one of Sir Alex Ferguson's kind of incubated players. Until they're sold, the club that incubates them, Manchester United, can't recognise their value on the balance sheet at all. Why not? Doesn't matter how much they're worth. It could be worth 50 million because the accountants don't let them. The accountants say until somebody else has paid money for that asset, David Beckham, you can't put him in the accounts, even if he's worth millions. So here's the bizarre thing. And as an investor, it is a bit bizarre. You're looking at one football club and another football club. You're trying to compare the two in terms of value. You're looking at the balance sheet. It's not a bad place to start. And you've got very different balance sheet values for even seemingly similar clubs. And basically, the difference will be one club buys lots of talent in and can put it on the balance sheet and then amortize it or write it down through profits. And the other one doesn't. The one that doesn't can't do any of this. It can't put the player in the balance sheet. You can't make up a number and say, well, if we sold him tomorrow, he would be worth 20 million. Doesn't work that way. Accountants don't let you do that. Okay. And same goes for software companies. They buy licenses. That goes on the balance sheet. They create their own licenses. It doesn't. So you get the idea. Now, as an investor, this can create a bit of a headache. Okay. The probably most straightforward way to solve it is, in valuation terms, be very, very careful not to just rely on the balance sheet. Okay, because there may be quite literally, in the case of a football club or a software company, assets missing. Okay, and secondly, watch out comparing two profit and loss accounts, because one may have, charges going through it relating to these intangible assets, players or software licenses. The other one won't, and that's where a lot of investors would say, well, actually, then I need some sort of measure that equalises this. All right, as I've mentioned in earlier videos, there is one. It's called EBITDA. It's not necessarily perfect all the time. I've done another video, what is EBITDA, but earnings before interest, tax, depreciation and amortization. That's profit minus all this monkeying about with sort of amortization, if you like. Okay, not ideal because for some sectors it does rather ignore the big impact of capital expenditure on the profit and loss account, and that's not always ideal, but that's by the by for this video. Or cash flow, all right? If in doubt, looking for a sort of consistent reported performance, the cash flow statement, and in particular, as I mentioned in the last video, free cash flow, can be a better measure. And there's a video out there called The Number the Directors Don't Want You to Find, which deals with the topic of free cash flow. So the message, in essence, in this video is, here's a little bit of messing around that company directors can do. To some extent, they're constrained by the accounting rules. It's not entirely their fault, this one, but do watch out in sectors where there may be high levels of intangible assets, football clubs with players, software companies with licenses and so on. Do watch out, because you can't always compare their balance sheets and their profit and loss accounts side by side.